Hello and welcome. This presentation is about price risk and how we can turn it into a source of profits and competitive advantage. Although we'll primarily discuss commodity price risk, the same principles apply to commodity, currency, or interest rate risk. Price risk can have massive impact on firms' profits and shareholder value. To illustrate, we'll look at the examples of two large gold mining firms and how price hedging affected their business performance. The price of gold rose steadily from 2001 onward. In 2010, ANGLOGOLD ASHANTI, world's third largest gold mining firm, accumulated large losses by hedging its exposure to this trend. ANGLOGOLD ASHANTI locked their forward gold sales at an average price of less than $450 per ounce, as gold price more than tripled to $1,400 in 2010. Instead of record profits, ANGLOGOLD ASHANTI took nearly $2.5 billion in losses from hedging. When gold price fell nearly $500 in 2013, BARRICK Gold, world's largest gold miner, posted a quarterly loss of $8.6 billion by not hedging their exposure to the price of gold. The cases of these large firms were severe, but they were by no means exceptions. A few years ago, we looked at the hedging practices of 9 independent North American oil and gas producers. These included Anadarko Petroleum, Apache, Burlington Resources, Canadian Natural, Devon, Encana, Talisman Energy, Unocal, and Kerr-McGee. While the first 8 of these firms on average hedged 25% of their 2004 production, Kerr-McGee decided to hedge as much as 70% of their production. In effect, Kerr-McGee set the price cap for their North American production below $28 a barrel. As oil price continued to rise, the average price for 2004 reached above $41. Kerr-McGee's hedging decision proved disastrous as it deprived the firm of an extra $13.72 per barrel, resulting in a $500 million revenue shortfall. Kerr-McGee fared much worse in the stock market. Its share prices lagged by over 33% compared to the other 8 oil firms, resulting in a $3.5 billion shortfall in market cap by August 2005. In other words, management's hedging decision helped destroy $3.5 billion in Kerr-McGee's shareholder value. More recently, a large-scale price event proved extremely damaging for commodity producers. In 2014 and 2015, commodity prices fell by over 50%. This decline was disastrous for the American mining industry, which includes oil and gas producers. In 2015, the industry suffered a total loss of $227 billion, erasing nearly 10 years' worth of profits. These events raise a question. Why do commodity price events have such enormous impact? The explanation is largely in the changing nature of global market environment. Over the last decade or so, the growing global economic and political uncertainties have had a dramatic impact on commodity markets. The changes are plainly visible in the historical price charts of many commodities. Since about 2005, many commodity markets have experienced a dramatic increase in price volatility and frequency of large-scale price events. As we saw with the cases of oil-producing and mining companies, large-scale price events are the greatest source of risk for commodity-related businesses. Given that timing and direction of such events are unpredictable, how can firms master the resulting uncertainty and gain control over this source of risk? Fortunately, we can accomplish this without having to know the future. This is thanks to the simple fact that markets move in trends. In the short term, market price fluctuations seem driven by data and news events. But almost invariably, large-scale price events unfold as trends that can span many months or even years. Trends are quite obvious in price charts of just about any financial or commodity market. We can see this in markets like crude oil, gold, copper, sugar, coffee, dollar-euro exchange rate, and many others. Because major price events unfold as trends, we can capture value from them and turn this source of risk into a powerful driver of value creation. We can do this by using the so-called systematic trend-following strategies. We can provide such strategies for your firm thanks to our proprietary iSystem technology, whose reliability and effectiveness we have rigorously tested for more than 10 years. Quite simply, iSystem is a reliable trend-following autopilot. It consists of a set of mathematical algorithms organized within 2 neural networks that comprise a body of codified knowledge in trading and market analysis. iSystems algorithms are driven by some 70 different calculation parameters, enabling us to formulate, test, and implement a very large variety of intelligent trading strategies. Each strategy's simple objective is to capture value from price trends while limiting losses from adverse fluctuations. Strategies perform their function autonomously, reducing the complex work of daily market analysis to simple, actionable trading decisions. If we refer back to the cases of 2014 commodity price crash and to Kerr-McGee's, BARRICK, and ANGLOGOLD ASHANTI's hedging mishaps, iSystems strategies have been on the right side of those market moves virtually without exception. This enabled us to generate significant profits where those firms took large losses. It is then fair to ask, how good is the iSystem? We have demonstrated its effectiveness in the most rigorous way possible by comparing its performance to world's leading commodity traders, the so-called managed futures funds or commodity trading advisors. We have done this by trading with real money, not just through mathematical simulations. Between 2007 and 2013, we used iSystem to run a diversified commodities trading portfolio similar to that of many typical managed futures funds. During that period, we outperformed the Credit Suisse First Boston Blue Chip Index of such hedge funds. The authenticity of these results has been independently audited by KPMG. Our track record spanned a period of 6 years, used 120 iSystem strategies in 38 different markets, and about 10,000 individual trades. These results testify to the quality of the iSystem and its effectiveness in capturing value from market trends. The following set of charts illustrates the performance of typical iSystem strategies. Take the example of crude oil. Here, in the top chart, we have the price of oil. Below, we see the long-term performance of iSystem trend-following strategies. iSystem's reliability is due to the fact that it can deploy a variety of different strategies within the same framework of knowledge. As time goes by, some of them will prove superb, like this one, while some might disappoint, like this one. By using multiple strategies, we significantly increase the probability of positive results sustained over time, as the 12 strategies we use to trade NYMEX crude oil so compellingly illustrate. We use the same approach in every market we cover. Here's how we've performed trading silver, again using a variety of strategies, some of which turn out superb and others less so. We can never predict how any individual strategy might perform in the future, but by implementing a diversity of them, we have much better odds of achieving positive results and avoiding disappointments. Here's how iSystem strategies traded gold futures, copper futures, coffee, and German BUND. Again, these results reflect live trading in real markets, not just mathematical simulations. As our results show, systematic trend-following strategies enable us to capture value from major price events and to turn commodity price risk into a source of profits. Yes, but we do not wish to speculate. This is what managers often tell us about the prospect of managing their commodity price risk. In today's environment, however, competitive pressures are tougher than ever, and as we have seen, so is market price volatility. Firms have become far more vulnerable to risk than ever before. This was made clear by the recent empirical study of the phenomenon. Boston Consulting Group studied 35,000 companies from 1950 to 2015 and found that today, the lifespan of public companies has almost halved from 50 years ago. 5-year exit risk for any public company rose from 5% to 32%. Indeed, business as usual is increasingly risky. With regards to commodity price risk, leaving the problem to chance or to half measures is no longer justified. Managers must take active steps to explore strategically sound solutions that will enhance their firm's profitability and resilience. Your firm should not sustain damage from the next severe price event. On the contrary, it should seek to profit from it. Commodity price risk should rightfully be regarded as one of the most powerful sources of opportunity for firms to generate profits, shareholder value, and competitive advantage. We can help your firm accomplish these objectives in 3 principal ways: by providing trading decision support, hedging process design, as well as market access and management. Quality decision support is the essential element of any effective hedging operation, as it frees managers from the stress and personal risk in speculative decisions. We can provide your firm authoritative decision support with our Trend Compass reports delivered daily to your inbox. Trend Compass reports offer trend guidance and trading signals generated by a diverse set of our best-performing trading strategies. The ability to rely on a top-quality, thoroughly tested decision support enables critically important advantages, like the solution to imperfect knowledge about markets, discipline and process transparency in trading, absence of rogue trader risk, dependable performance in trending environments when the potential for gain or loss is the most important, as well as a whole range of competitive advantages. Beyond providing daily market guidance, we can help you design, document, and implement a comprehensive hedging operation so that it can make an integral part of your firm's business process. Where needed, we can assist your firm with opening competitive futures and options brokerage accounts, executing transactions, and even managing part of your hedge book, always with a full daily transparency. To sum up, Altana SmartHedge offers top-quality solution for your firm's hedging needs thanks to our long continuity and hard-won experience in commodities trading. We can help improve your performance with ready-made decisions, not just more information and analysis. Importantly, the quality of our technology minimizes the so-called model risk. Our approach further ensures a uniquely high level of process transparency. Finally, we are there for you for any further advice or guidance. To learn more about the philosophical and technological foundations of our 20-year development, you may consult Alex Krainer's highly acclaimed book, Mastering Uncertainty in Commodities Trading, which we are happy to share with you. We can think of no more appropriate words to conclude this presentation than those of the great poet and philosopher Johann Wolfgang Goethe. Whatever you can do or dream you can, begin it. Boldness has genius, power, and magic in it. Begin it now. Thank you for viewing our presentation and for considering Altana SmartHedge as your partner in turning commodity price risk into a source of profits and competitive advantage.